The Morgan Report with David Morgan.
David Morgan with you with the weekly perspective for the week ending 10 August 2018. Well, the currency crisis that I've forewarned about for years is coming to the fore again. This is from Wolf Street. Turkish banks scramble to stave off debt crisis as lira plummets. The lira, of course, is in big trouble, as are other currencies globally. The idea of the euro really combining all of these states in Europe, or I should say countries in Europe, to band together and have one currency has been really a big failure because it's really impossible, especially where their debts are separate and the currencies united. I think most of you are aware of what I just said. CNBC went on to say that the euro slips after reports of the European Central Banks concerned about exposure to the lira, the Turkish lira. So, high leverage companies are currently facing a potential cocktail of soaring borrowing cost and plunging lira. As the local currency weakens against the dollar, it gets harder and harder for local companies to service foreign currency bonds. That is how a currency crisis becomes a debt crisis. The difference? Currency crisis is your currency is failing. Debt crisis, all the loans in that currency start to fail. And since the euro ties many countries together, it's a domino effect. There's no ifs, ands, or buts about that statement. Similar to looking at it even on a bigger scale, which means the global debt situation, as the dollar goes, basically so goes everything else. Next one up, Charles Hugh Smith, always a great thinker, and I love reading this stuff. I don't miss much. The fantasy of balanced returns, quote unquote, funding retirement. Just get into the crux of this. The fantasy is based upon a belief that yields will exceed real inflation for decades to come. You will hear this from almost any financial planner or wealth manager that you care to go to. They're going to tell you, we're going to get you this amount, and this amount's going to, be great for your retirement, blah, 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 blah. And basically, they may or may not know it's a big fib. So, continue with the article. That is, if inflation is 2% and the average yield of a balanced portfolio is 6%, then the inflation-adjusted return is 4% annually. Not great, but enough to secure a retirement income. But if you dare to ask, and what's the truth? What's the real inflation? That's me. In the article, if you dare to ask, what happens if inflation is 7% and the yield drops to 2%? Then the retirement fund loses 5% of its purchasing power every year. And that's basically the status of almost every pension that's out there. In a decade, the fund's value will decline by roughly half. So if you're retiring at 65 and you got X amount and you think you're pretty good and you actually believe the lie of what these numbers are instead of the truth, your purchasing power will roughly be one half of what it is when you are 75 and half again at 85. And I think that's rather conservative. I think it could be worse than that. So I won't read the whole article. He goes through and shows, data that supports what he's talking about here. And the acceleration, this idea that people don't understand an exponential curve. The debt's gone exponential, and it's been that way for quite some time. The debt to GDP is increasing across the board. And countries do go bankrupt. Things do mount up into a situation where we are right now, which means the global financial crisis of 2008 was never solved. All the key problems that were at the beginning of that era, or the 2008 crisis, still are with us, and in many cases have actually grown in size. Being able to have a government bail out the situation on the back of the taxpayers did work, I would say. I think it's been pretty benign as far as the average person is concerned, unless you look into the numbers, for the last decade, which to me, I'm actually surprised it's gone that far, but it has. However, the next time it probably will be the ability to bail out everything will probably go away, which means that another solution will have to be developed. Could be the SDR, as Jim Rickards has talked about, or it could be a situation where it's really difficult to get a handle on. Most likely, bail-ins, which will really upset the populace. So it's going to be interesting as we go forward to see how this unravels the next time around, but we are getting hints of it right now from what's going on with the euro. And then if you look further into the debt problems, you look into student loans, you can look into what I just outlined with the pension problems. And of course, the big problem always is too much debt. Next up is from goldsilver.com, my friend Jeff Clark wrote this article, and he talks about Mike Maloney, another good friend, talking about this economist writes that the next crisis could be worse than the Great Depression. Number one, private debt is too high. And as you can see, what kind of private debt per GDP we had in the 1930s and what we have really right now. And during the debt crisis of the 1930s, which was a debt liquidating depression, not an inflationary depression, you had a great fall in about a 15-year period. And we have had much less of a retraction in that space during this last, let's say, 9 years. And that's because the problem hasn't been solved. During the Great Depression, basically, they made some errors. They actually had a recovery, and then they started a policy which really turned the system around in the wrong direction. They realized that, turned it back, and basically came out of the Depression. Although many argue, and I'd be one of them, that really there was still insufficient economic activity until World War II, but that's another story. So another great chart here. Federal debt as a percentage of gross domestic product. It's at all-time highs. And of course, that's no surprise to anyone that listens to this weekly perspective. The global debt is growing 281%. We could round it up to 300% or tripled in the last 17 years. Goes back to the earlier thing I was talking about with the pensions. I mean, if you assume that you're getting a 4% gain over the true inflation rate of the real inflation rate, whoop-de-doo, great, and I hope you are. However, if you look at this debt burden, people are borrowing because they have to. In a lot of cases, let me restate that. Companies are borrowing because it benefits them. In some cases, they have to. In most cases, in the stock market, many of these corporations who have really increased their debt burden, as you can see from this graph, have done it to basically buy back their own stock to make their stock prices go up because their bonuses are based upon how high a stock price they have. All this has gotten into a great financial bubble, as we all know, and it's become a financial house of cards. And most people that don't understand how finance works, just look at these big numbers, think that a stock market is reflective of the true physical economy, and it looks really, really good based on those numbers. The truth is, it's a big lie, and I don't think we're going to go much further. Many do. Many think that stock market's going to 50,000. I'm not one of them. I think we'll probably see some sort of pullback in the major stock markets of the U.S. and, of course, other countries before the end of this year. Second point, the crisis will be global. The second reason the upcoming crisis will be potentially worse than the Great Depression is because it will affect virtually the entire planet. Mr. Keene classifies debt-laden countries into two categories. The first are debt zombies, as he calls them, classified because their private debt exceeds 150% of the gross domestic products of that country, B, credit is 10% or more of GDP for the preceding 5 years. See if your country is on this list. Debt zombies. I don't read them all. Well, I'll read them all. U.S., U.K., Denmark, Japan, Ireland, New Zealand, the Netherlands, Portugal, Spain. The second category he classifies as future debt zombies. Hong Kong, China, Australia, Belgium, Canada, and South Korea. These futures debt zombies will suffer credit crunches in the next few years and then join the 9 zombie countries. When that happens, the majority of the world's economies will be in the doldrums due to excessive private debt, and the world will experience the kind of economic malaise that has afflicted Japan for over a quarter century. And I very seldom comment on the comments, but this comment I think was so to the point that I wanted to show it in the video. And for those on the podcast, it just shows America's finances from roughly pre-Reagan all the way through to Obama. And what it shows at the top is the revenue base, how big the deficit keeps getting. It ebbs and flows, but generally it's going higher. Yet the debt load to support it keeps increasing exponentially. Very worrisome if you understand, again, what an exponential curve means. We are at a point now where I don't think it's going to go much further. And with all I just went over for you on this Friday the 10th, you would think gold would be reacting more as a safe haven, and it is not, at least not today. Gold is still struggling with the level of about a yearly low, about 1,200. I actually think two things. I think that we will see the low for the year this month in August. We're a third of the way through it. I do expect to see a traditional, what I call spike low in silver. It also could be a key reversal. This is where you get a very strong spike down, like let's say 30 cents, for example. And a key reversal is where you get a spike down, which is lower than the day before, and then it comes all the way back during that same day and is closed higher than the previous close of the day before. Those that are not familiar with the term, if you're even interested, you can look up key reversal on Google. It'll explain it. So it is bewildering with all that I just showed you that you're not seeing much action in gold, but these things move not day to day. In other words, there's no real reaction in gold. Sometimes it's a delayed reaction. I've read several that I consider to be very worthwhile on the gold feeds this morning, and several make strong cases that they see gold bottoming, not the exact bottom, but bottoming. In other words, the process is starting to get way too negative, too many shorts, too many people that think gold can only go down. So they're using a lot of their indicators that it looks like the gold and silver markets are pretty much near a low at this time. And for those out there that are members or not, I just want to remind everyone that I do consultations. I just did an hour-long consultation this morning with a gentleman from New York. And a lot of people don't really need, like the Morgan report, they're already satisfied with their positions or whomever they follow as a financial advisor or newsletter writer or whatever. However, at times they're a little bewildered or the asset allocation or where to store or a lot of questions. I mean, basically it's an open discussion, and it can be as easy as a half hour. A lot can be done in a half-hour consultation. In fact, most are a half hour. And of course, it's a money-back guarantee. It's not on this page that I'm showing you, but I want you to be happy. So if we get in 10 minutes or whatever, or even a whole thing, and you think you didn't get your money's worth, let me know. Just refund it. Most cases, I've not had a case yet where people weren't satisfied to very satisfied with the consultation. It's not for everybody, but sometimes there's that one question that's just grinding at you. You really like to talk to someone that's not only been in the metals business, but been investing since they were 16 years old. I've got over 4 decades investing in stocks, options, bonds, spreads, you name it, master limited partnerships, private equity, financings. I mean, there's probably very little I haven't done, and learned most of the stuff the hard way, meaning I've made errors along this road, along this path, but I'm certainly happy to share my experience with anyone that would benefit from it. So just a quick update on that, and I'll be with you next week. Remember, there's nothing more powerful than the truth.
Stay up to date on everything in the global economy, the currency crisis, cryptocurrencies, and the hard asset sectors such as gold and silver. Sign up for our free weekly perspective updates at themorganreport.com. While you are there, be sure to check out our membership services, where you can get expert trading recommendations and read analysis for just $50 per month. The Morgan Report is a world-class publication aimed at helping you secure your financial independence, regardless of the economic outlook. It's the knowledge you need to protect and grow your wealth.